Hello again. I am back. Thank you, everyone, for tuning in. I will be delving into different topics. I started a series of videos that I will get back to, going over the tax triangle and banking like a bank. However, there are some housekeeping tasks that we should do from a financial standpoint. One of those standpoints is healthcare. If you can have all the riches in the world, but if you don't have your health and the finances to manage those health troubles, we can find ourselves in a world of trouble. And I'm assuming that there are some biblical scriptures on there, but we won't talk about religion today. Please like and subscribe to my channel. I'm trying to get my own YouTube channel. That would help if I had some subscribers and some likes. All right, so first thing that we are going to talk about is the deductible versus out-of-pocket expenses. Now, these expenses that we have deductibles and we have out-of-pocket costs. So your insurance starts covering a portion of those healthcare costs once you hit your deductible. And that covers all your medical costs until you reach your out-of-pocket maximum. So we're going to go into those maximums. Okay, the way this works is how insurance works is it works in 3 phases. You have a deductible. So when you go and see a doctor, you pay your deductible. You have a co-insurance, and then you have a maximum out-of-pocket cost. And this is the maximum phase. I'm experienced in healthcare insurance, Medicare insurance, health insurance, so I understand these numbers very well, and I'm going to go over with you. And typically there's an 80-20 rule. However, if it was 100%, we wouldn't be making this video, so that 20% must count for something. So first thing we're going to talk about is the deductible. So with that deductible, you have that first phase before your insurance kicks in. You're going to have to pay for all your medical costs until you hit that deductible. So let's say hypothetically, if you have $1,000 deductible, you're going to spend that medical expense before you get help for insurance. Sometimes I go out and I speak to business owners, and for the most part, I feel like Cesar Chavez or Harriet Tubman trying to convey the importance of the high cost of medical bills to employers. And the facts are, if you look down here below, 52% of healthcare employees say that they couldn't pay $1,000 of out-of-pocket expenses. However, the employers feel that the employees are just fine and that they can pay this. So the higher cost of insurance gets passed on to you via the employer, or even in the markets out there per se that are not controlled by the market, employers that are not involved in that. So you can buy insurance on the market. So those out-of-pocket costs are being put onto you. So second part of that phase is the co-insurance. So here comes the cavalry. So let's say you've met your deductible and you're feeling good. I paid that $1,000 deductible, but there's a co-insurance pocket. So let's say you go to a football game or you have a kid and they break their leg and it really hurts themselves. So you can see the young lady down here in the bottom, she goes co-pay, co-insurance. She's like kind of confused. So, and I'm going to wrap all this in together at the end, and it's going to make sense to you why you do, if it's like those things that you don't know can really hurt you. Now, if you're the type of person who doesn't work, who doesn't care about their credit, never will pay a bill, this video isn't for you. So you can turn it off right now. But this is for those people who, you know, have insurance, who feel they're covered and that their employers are taking care of them. But we're going to take a closer look. So let's say if you do have an 80-20 plan, that means you'll be responsible for $500 of that health insurance cost. So over here, in this little illustration, the core insurance refers to the percentage of healthcare costs paid by the insured after meeting the deductible. So you keep paying your core insurance rate of medical expenses for the year until you reach the maximum out-of-pocket cost. Now, which will bring us to the last phase. So praise be all to God, Allah, or whomever you should work. So once you've hit your out-of-pocket costs, you've done your insurance plan will pay 100% of the rest of your medical costs for the year. And all you have to do is keep paying the premium. So, but here's a good surprise. The maximum limit set for health plans in 2021 was $8,550 for an individual for maximum out-of-pocket costs. And for families was $17,000. So the negotiation between your employer insurance is actually changing. Now, the good news about this, we get to celebrate every year. And the reason we're going to celebrate is because you don't get any credit for what you paid off last year. That rollover cost, it just repeats itself every year. So your deductible that we just walked through, it repeats itself every year. So we want to celebrate our medical plans every year. So I'm going to wrap this up a bit and let's show you this over here. Co-insurance versus co-pay. So I'm just going to wrap this up, even though I covered it, just going to go over it again. So let's say, for instance, if you're paying a percentage of your medical expenses, co-pays, or for a flat fee for a doctor visit and medical trips to the emergency room, your health insurance plan sets a co-pay fee for different types of health services. So let's say hypothetically you get sick, you take a trip to the doctor's office visits cost $150. You're going to have a copay. Copays can range from $10 to $50, depending on what they negotiated. However, conversely, those lower copay numbers sometimes equate to higher out-of-pocket fees. It's almost like an inverse relationship, and you learn that in math, opposites attract. So those copays will go towards that cost. So say your health insurance pays $100 with an 80-20 plan, you would have to pay a $30 visit. $30 is 20% of the $150. So you can either have the straight copay or you can have that 80-20 rule. Co-insurance versus copay. So it gets a little more complicated here. What doesn't get complicated is just in depth. But then 2 weeks later, let's say you need to go to the emergency room. And this time you get hit with a $2,000 price tag and a copay of $250 for an emergency room visits. That's how much you owe, 20%. With 20% co-insurance, your share of that cost is $400 of that $2,000. So that's a 20% copay. And we are going to wrap this up. Okay, so the reason those copays are important, and what I like to do is I like to take people directly to the source. I don't like to make up stuff. So let me see if I can blow this up a little bit. Now, I'm not going to promote this website, but if you want to go to this website, go feel free to. So if you can see here, the average American, let me blow it up a little bit more. I guess that's good. Spends about $5,000 in out-of-pocket health costs each year. Almost 60% of adults have medical debt at some point in their life. 70% of medical bills percent of people with medical bills had to cut back their expenses in food to avoid bankruptcy. So 2/3 of all bankruptcies are due to medical bills. And there's a Harvard study out there that shows that 75% of those who do file bankruptcy have medical insurance. So 20% of bankruptcy filers are actually 55 and above. And we're not going to go down this point for point, but I just want to re-emphasize on the video that I'm making here. So in 2000, the average medical insurance premiums increased over 50%, and Americans spend on average out of pocket of $5,000 annually. And we are going to continue to share our screen here. And I want to show you some workforce reports. So just based on the $5,000 that we said that the average person has to spend on medical costs, what we found here during a survey is that 50% of employees do not have $1,000 to pay out-of-pocket costs. However, there is a miscommunication between employees and employers who assume that their employees can meet these financial obligations while they negotiate insurance plans that pretty much go up in cost and lower services. So today I am going to be discussing a couple plans, and these plans are AFLAC plans. And these plans actually bridge the gap between the cost of Medicare medical costs and your out-of-pocket expense. So I'm going to touch on these briefly, but I would encourage you to reach out to your employer to see if you can get these plans at your job. The average medical expense for an accident injury is $5,600. And 1 out of 8 individuals will be sick. So we're going to go through here. And we're going to just take a look at this here. Let's say, hypothetically, if you're playing accident hockey or an accident that happened, you had to go to ER and your leg is broken and there's a surgery performed, AFLAC will pay out this benefit amount to you, which is $6,625. So if you go check the cost of medical expenses, you'll see that this goes directly to you and not the hospitals. So that's the benefit of an AFLAC plan. So let's take a close look. So let's say if you have a hospitalization, AFLAC will pay you $1,500 for an accident, $300 confinement, plasma, surgery, etc. They also have critical care plans that can cover you. And this AFLAC is not the only company out there. There's other companies, but AFLAC has been around the longest. Typical person on this plan suffering from a heart attack would have been paid $16,000. And this money goes directly to you. If you reach out to me and contact me, I can give you some examples, real life examples of how we pay benefits to those who are injured or sick. So what this does covers heart attack. So if you have a heart attack and you have insurance and you're out of work, how do you pay your bills? These are just facts. So these plans cover all different areas. And then last but not least, for those who would be concerned about cancer, AFLAC also has a cancer plan if it runs in your family. I know people who have survived and beat cancer have been paid benefits in excess of $30,000. And as a matter of fact, this is how AFLAC first started off. And this plan right here gives you a $100 benefit to actually go visit a doctor once a year. So these plans can almost pay for themselves in a sense. And that is going to cover my video for today. And thank you.